Good morning, everyone. Thank you for joining us on this webinar this morning, going over the OneAmerica product and the advantages that it has. My name is Paul Williams. I'm a life sales director over here with IAMS. And before we get started, there's a few things that I would like to point out about the services that we offer here at IAMS and the things that we do for our advisors. I will be presenting a few questionnaires throughout the webinar for y'all to answer. And if you have any questions about the information that we're going over today, just put them in the question box and we'll get those answered for you today. The first thing that I would like to point out is our new producer bonus that we have over here with IAM. So this is for newly contracted agents throughout the first 180 days that you're contracted here with us. And as you can see the levels on the screen, so once you have your first $100,000 of paid business, you qualify for these pieces. And of course, as you produce more, you qualify for additional marketing or even money to be sent out to you. And also here at IAMS is our business builder. So we do have a referral program that, if you refer somebody over to us, we'll cut you a one-time $50 check just as a thank you. But where the real money is made on this stuff is you get a piece of override on all their business that they are producing here with us at no effect to the writing agent. And I've seen Curtis and Chris and Charles cut thousands of dollars check every quarter on this stuff. And also another way that we're just a true partnership over here with IAMS is our marketing reimbursement. So we'll put $100 to your marketing for every $100,000 of FIA business placed here with this, $200 for every $100,000 of single premium life, and $200 for every $10,000 of life target premium. Moving forward is our back office support here at IAMS. I mean, we were founded on customer service, 37 years ago by Charles, and that is still a staple of where we stand behind. Our case managers work endlessly to get y'all from submission to commission and business paid faster. They'll give you regular updates. They'll scrub applications for you. They'll submit them on your behalf. And also, our marketing team does a fantastic job of getting, illustrations and quotes and stuff out to y'all within 24 hours, but in most cases, it's within a few hours. And also, our IAMS website is an amazing resource for our advisors to use. We get quote engines, we can get you forms, we get industry links out there, annuity grids, LTC product grids, underwriting guidelines, pre-screen forms, all the things that you would need to just make that submission to commission to go a little bit faster. As well, out there on the IAMS website, we do have our e-app solutions. Makes it really simple to submit business here. Everything's highlighted for you. Fill out the information, get it sent in, goes directly to the carriers. And also, as you can see, the carriers that we use for our Firelight and e-app solutions here. So, I mean, this is single sign-on, really simple to use. And another service that we offer over here at IAMS is our creative marketing solutions. Now, these people work in the industry every day, so they know what clients are looking for, how to design websites. We can build out logos for you, build out marketing campaigns, mailers, things like that. And once again, I mean, these people work in the industry every day, so they know what's going on and how to design this stuff. So it's definitely customer facing friendly. And our IAMS Wealth Management has been a really strong sector of growth for us. It was brought to us, I think, 5 or 6 years ago now. But this is just another way that we add value to our advisors and really help that business become more sticky on y'all's end as well, and just providing that holistic retirement solution there. We do offer life and annuity academies here. We actually have one coming up next week. Then we'll have another one coming up in September. There's more details on that to follow. If you have any questions about that or you would like to attend, reach out to me at paul@eimsinc.com or give your sales director a call, 1-800-255-5055, and they'll be glad to get that scheduled for you. And as always, like and follow us on Facebook and LinkedIn. We're constantly putting out information that you can use on your website to get out to your clients. But from there, I'm going to turn it over to Brent, and he's going to go through this amazing product with us today.
Well, thank you, Paul. Appreciate that. I am going to show my screen here. I probably have to swap it once I put it in presentation mode, so give me a moment.
Yep, perfect.
Swap. All right, that should be, I'll just take a look at what the audience is seeing. Yes, excellent. Well, perfect.
Yep, perfect.
Again, Paul, appreciate that. Great lead in. For everybody that's on the line today, I am constantly amazed. Every time I do a webinar with one of IAMS, I am just blown away by the amount of tools and support and that sort of thing that they provide any of you that contract with them. So keep up the great work there, Paul. Great partner with us as well. So thank you for the buy-in also. So really what we're talking about today is certainly extended care planning. IAMS does a lot of things with annuities and life business and, brokerage kind of accounts. But one of the other pieces to anybody's retirement portfolio is protecting themselves from an extended care event. And that is still one of the largest risks maybe to anybody's portfolio. So when you're working with your clients, if you're not talking to them about extended care planning, I hope that you're here to learn a little bit today about some of the options that are out there. And we've got some great solutions to do so. And that way you really protect that portfolio that you're helping them grow, year in and year out, and really can put their minds at ease for any extended care needs that may come into effect. So with that, I like to talk about two E words here: efficient and effective. And so we're going to really be talking about this from that perspective as we go through this extended care planning presentation today. And so I guess without any further ado, I'm just going to lead in here and talk about OneAmerica in and of itself just a little bit, just to make sure that you understand who we are and really what we do. So we are an asset-based LTC market leader. So what does that mean? So when planning for long-term care, there's a couple different types that are out there to plan for any extended care needs. There's the traditional long-term care insurance. I've worked in this industry now, long-term care industry, for over 22 years. And 17 of those were spent at a carrier that had the traditional type of planning. Never a bad option. I will not talk disparagingly about any traditional plans, but we have seen where there's a shift in the marketplace for consumers, understanding that these asset-based solutions may be exactly what they're looking for and maybe more what they were looking for as well to protect their portfolios. So we've got the traditional, we've got the asset-based solutions, and then there's some riders just on a life plan that you just quickly check a box. I will caution you just a little bit on those. Yes, that will possibly plan for some long-term care or extended care needs, but typically you don't know how much you're going to get at any one point in time. There may be some underwriting that happens at the time of claim, and so there's a little bit of difference there. But some people just kind of take that approach, and it's a very easy check mark on the application and move forward. But I really wanted to dive into what our asset-based solutions are and why so many consumers are looking at these types of planning options and saying, gosh, that's really what I'm looking for. So let me talk about a little bit, again, about our financial strength and our commitment to the market, and certainly the innovation that we have here. So you can see we can trace our roots back as a company, OneAmerica, all the way back to 1877. We're A+ rated, current Comdex is 95, so all that goes to speak to the financial strength of who our parent company is, which again is OneAmerica. We're located in downtown Indianapolis. This is actually that rendition there is a sketch, if you will, of our building in downtown Indianapolis. Did want to talk about our commitment to the market as well. We are a mutual company, and I think most of the players in the extended care planning options are mutual companies, and that's probably really what you want to look for, because we are always working towards, bettering our pricing and making sure that the customer, which is our policyholders, are treated in the best light and getting the best value for their money. So that's really what a mutual insurance company is. We're owned by our policyholders. So that's what we're always working for in the long run. That should bode well for you, just knowing that, once you suggest them for us, that we have their best interest in mind, not that of maybe a stockholder. Innovation. So we were one of the first to come out with these asset-based solutions. So our first iteration of Asset Care, which is our life-based chassis, and I'll talk about that here in just a minute, came out in 1988. That was the year I graduated from high school. So it's pretty tough for me to always remember that year. But like I said, one of the first to market with these types of plans. And we've got some table stakes really with us that set us apart from our competition. And so we're going to talk about some of those as well. And you can see something here. We've got joint coverage. Now, we did have a competitor of ours come out with joint plans. We actually had a patent on it for many, many years. We did do some updating to our pricing and policy structure, and that allowed that patent to run out. And therefore, one of our competitors decided, hey, we really want that as well. So there is somebody else that has joint coverage, but we're still the only one, the first and only, that first had joint coverage, but only have a lifetime benefit option. So our continuation of benefits rider will really cover that catastrophic risk. And especially if you're doing a joint plan, putting two people on one policy, it makes incredible sense to only make sure you've got a lifetime option that says no matter what any one or both of them need as far as benefits are concerned, it's going to last for the lifetime of both of them. Those benefits will never run out. So that really gives the true peace of mind when planning for any extended care needs. And we've got several funding options which differentiate us as well, even qualified funds. So I'll talk about that here in a little bit as well. But let's look at really, I like to try and keep things simple. We have created many options to meet any one client when and where and how they would like to put a long-term care plan in place. The problem with that is sometimes it gets overwhelming to those that are certainly new to OneAmerica and looking at some of the options. So I try and boil it down to its simplest denominator here. And that is this. It is basically a base policy, right? So the client is going to take out a base policy, and that's their asset. Now, we're the only carrier out there that has a platform or a chassis for two different types of base policies. We've got a life insurance chassis, we call that Asset Care, and then we've got an annuity chassis, which we call Annuity Care. And I'm going to be talking about both of these today and why it's so important and maybe where you want to look to one solution versus the other. So that's the base policy. That's their asset. They're going to use that first if they ever need any extended care services. That's where we're going to get the income from, is that base policy. So that's their asset. What we can do at the time of application is add what we call a continuation of benefits rider. And so those are those lighter two bars on the right-hand side of the screen there. So we can be like our competitors out there and do a limited COB rider. But really what sets us apart is our unlimited lifetime COB rider. And again, whether it's individual or a joint case, having the wherewithal to know that you're never going to run out of those benefits really puts people's mind at ease when planning for any long-term care services. So we've got a couple ways that we can do that. Now, I look at that as really kind of the catastrophic risk. So we're taking that catastrophic risk off the table for them. Yes, they're going to self-insure using their base policy first, but the rider would then kick in once that base policy is exhausted and cover that catastrophic risk that really what we're looking to plan for against. That could be things like Alzheimer's, dementia, Parkinson's, those that could last 10, 15, 20 years into the future. And that's really why our lifetime unlimited COB option, especially on joint cases, we're seeing that in nearly 70% of the applications that come in. So very simply, it's a base policy plus a rider. So if you understand that concept right there, you've got 98% of our plans. Now we can get into a little bit of the weeds and just show how much flexibility OneAmerica has and how we design these types of plans. So first and foremost, I'll talk about kind of the funding options. And I mentioned this early, but when these long-term care plans or the asset-based solutions were really created, they were all done on a single pay basis. Largely, it was just repositioning an asset from one pocket to another, or just taking a portion of their portfolio and putting a long-term care plan in place through a single premium. Well, the longer that we've done this, and I should mention this very quickly, we are now in our 36th year of doing these types of planning. That really gives us all the insights and looking at claims and administering claims and filing products, pricing those solutions and that sort of thing as well. So we've got a lot of experience here in these types of solutions. But we also recognized over that time period now that single premiums aren't available for everybody. Not everybody has that just a way to quickly shift a portion of their portfolio to an extended care plan. So we came out with a number of other options. So some recurring premiums. And so we've got a 5-pay, a 10-pay, a 20-pay, even a pay to age 95, which is kind of our annual pay, if you will. And we're seeing more and more of our consumers or applications that are coming in applying on that annual pay basis. Now, that could be just an annual pay for the rider portion and single pay for the base, or it could be done both ways. So it could be an annual pay for both base and rider. So lots of ways that we can really design these types of plans. The other thing I mentioned is that we've got the ability to take qualified funds. So everything I've been talking about so far has been non-qualified, right? After-tax money. But we've got the ability to take pre-taxed money, so qualified funds, and we've got an excellent solution that I'm going to talk about here at the end of this presentation today as well. So qualified funds, non-qualified funds, 1035 exchanges from cash values, income from SPIAs, things of that nature. So lots of ways that we can fund that base policy, right? Meeting the client where and when and how they can. Funding options for the rider portion, essentially the same. But one thing that I'll point out there that you'll see in the red there are continuation of benefits, or COB, as you'll hear me refer it to, is 7702B by IRS standards. That says that can be tax qualified, or an individual or a business could actually take a tax deduction on that portion of the policy. I don't have time to get into all of that today, but I just wanted to make sure that you were aware that our rider is 7702B, could be tax deductible depending on how somebody files. All right, so let's look at, I mentioned lifetime and why it's so important. So here's the concept of lifetime benefits. Basically, we've got a very well-balanced portfolio here on the left. And essentially what we're gonna do is just, again, reposition a portion of that. Now, this could be done in a single pay basis, a 5, 10, 20 pay, or annual pay basis. But we're just gonna peel away a portion of their overall portfolio, create a plan, that base policy, if you will, that will have the LTC benefits or benefits that would be payable for any LTC needs out of that particular policy. So if it's an annuity, it would be out of the cash value of that annuity. If it was a life insurance plan, it would be out of the death benefit of that base asset policy, right? So all of that will pay for those LTC benefits. But what happens is that can be used up completely. That's when the COB rider kicks in, continuation of benefits. And again, we've got the only lifetime solution out there that will just give your clients the total peace of mind when planning for this sort of risk. Because what happens if we plan with a limited option and they exhaust those benefits? Well, now they're right back into that same portfolio, pulling out of that was earmarked for retirement that you were really trying to protect. So why wouldn't you do for, maybe 5, 10% more, a lifetime solution that will put all of their minds at ease? So like to really talk about that and explain our concept with the lifetime COB rider. All right, so let's get into our solutions here. I'm not going to go terribly in depth because, again, you've got IAMS at your resource. Your sales director there at IAMS is going to help you with any of our solutions. So you just bring them your client scenario. They'll help you design a plan. Many times they'll come with us and we'll work together to design those types of plans. But I'm going to start with our annuity care chassis first and foremost, and then get into our life chassis here in just a minute. So let's talk about the annuity and why we really use that. Well, there's a huge opportunity for any of you on the line today. The federal government had the wherewithal to realize that this age wave is coming. It's been called or coined the silver tsunami, if you will. And that's really all the baby boomers aging through, getting to near claim age. When we're talking Medicare planning, that whole age wave was hitting there as well. So those boomers were turning, 10,000 of them every day turned 65 quite a number of years ago. And as a matter of fact, in less than 3 years, those same boomers who turned 65, 10,000 of them every day, are now going to be turning 80, which is anywhere between 80 and 85 is the average of when claims start to happen in long-term care. So they're going to be hitting that very forefront of possibly needing care. So the government had the wherewithal many years ago to say, all right, we need to help clients and advisors and insurance producers like yourselves take the general public and help themselves plan for these types of risks out there. And basically what they did is they created the Pension Protection Act. Now, the Pension Protection Act did many different things, but when it came to long-term care planning or extended care planning, it really allowed us to take an existing annuity, 1035 exchange that, so just a simple exchange with some underwriting questions, and I'll talk about those in a minute. But if you just exchange that non-qualified annuity from where it was at into a Pension Protection Act or PPA annuity, then all of the interest, all of that gain portion would become tax-free. So let's look at this existing non-qualified annuity, and let's say your client took it out for $50,000. Over the years, though, it has gained another $100,000, and all of that gain is taxable. So when they go to take withdrawals from that non-qualified annuity, and we've done some surveys out there, and many clients that took these non-qualified annuities out years ago wanted it for tax deferred interest, so it's doing exactly what it needed to there. But we asked them what would trigger them to, or ask them what would the deciding moment that they would trigger that annuity, and many of them said, over 80% said a health scare or health event. So essentially saying, protecting themselves from any long-term care expenses. Well, if they left that non-qualified annuity where it was at and only accessed it once they needed claim time or needed the money, the income for that, that particular experience, they're going to be taxed on all of that gain. But by simply 1035 exchanging into a Pension Protection Act annuity, which all of the annuities at OneAmerica are, now it all becomes income tax free as long as it's used for long-term care. So again, the government had the wherewithal to see this silver tsunami coming and are really helping you work with your clientele to make sure that they are protected. Why not do a simple 1035 exchange with some very easy knockout questions? Again, I'll show you those here in a moment, and make that so all of that gain portion could be income tax free if used for long-term care. Now we can add our continuation of benefits rider to these types of plans as well, but I really want to give you some options up front, a really good scenario to help you find some quick wins in long-term care planning with your clientele. Now, let's say your client 1035 exchange their non-qualified annuity into our PPA annuity as well and never used it. Well, it's going to act just like it would have had they left it there. So it still passes on to their heirs, but since they didn't use it or only used a portion of the annuity, any of the gain that is still remaining in that contract would be payable to their beneficiaries. So no skin off their back here, just some simple knockout questions to make that all income tax free if they do that 1035 exchange. Now, you may be well aware of doing 1035 exchanges, and there's some limitations that the IRS and the NAIC put out there that said, okay, if we're going to 1035 exchange it, it must be like for like. So many of these non-qualified annuities would be singly owned, right? But now they realize, hey, I may make that for our long-term care plans. Mr. and Mrs. Jones, we're going to look at that and we're going to take that singly owned annuity and we'll make it available for both of you for long-term care. So we have an option called our eligible person provision. Now it must be a spouse, but if we can still 1035 exchange a singly owned contract, it's still singly owned, so move it over, but we add the eligible spouse. Now they both have joint access to all the benefits there. So it's a best way, I think, in helping your clients, plan for any long-term care expenses and get some income tax-free money from the government by using their non-qualified annuity or just 1035ing that annuity. So really great solution here. Now, if it was jointly owned, we just move it over. It's jointly owned there as well. So really wanted to talk about some options there. Now, here is some things that I really wanted to hit on as well. So why an LTC annuity? Well, on the left-hand side of these columns, or really, I guess it would be the middle column, but the existing or old annuity, why did they take it out originally? Well, for tax-deferred growth. Okay, checks that box. Growth potential, checks the box there. Access to the account value, of course, checks that box. And the bottom one there, if they never use it, beneficiaries are taxed on the gain. So it still goes to the beneficiaries, and that tax is passed on to those beneficiaries as well. Now, by just 1035 exchanging, we've got some extra check boxes that we can do here. But all of the others are still checked as well. So deferred growth, growth potential, these have interest rates that are growing that annuity as well. They've got access to the account value. They can pass it on if they never need it. But now, by just 1035 exchanging, all the gain is income tax free if used for long-term care. They can add the spouse to really maximize that old non-qualified annuity. And all of our policies here at OneAmerica come with our LTC claims concierge service, which we get a ton of great feedback on. So here's another nice little thing that I wanted to point out. We now have instant approval if you're doing these 1035 exchanges on these through our e-app. So basically, if the clients can answer no to all the knockout questions, we've changed the maximum from 500,000 all the way up to $1 million, and we'll pay full comp on that. And doing it through the e-app will give instant approval. So they'll know right away, hey, we're approved. So can you see where this, instant approval on LTC in the same sentence? That almost sounds oxymoronic, but really we've got a great solution to do so. So here's a simple strategy for maybe some of your older clients. Do a quick review of your book of business, if you will. Do you have clients 75 to 85, even up to 87? If you've got some of those clients, do they have old annuities already on the books? Let's remember, that's a dead asset to you, right? It's existing, it's working for them, but it's not doing anything for you. So it's a dead asset. Are they concerned about long-term care costs? Those are some good questions to ask. If yes to any or all of those, really look to our solutions here, answer no to those questions, and the client can be instantly approved. All right, so what are those knockout questions? Well, you'll see that there are 5 here. It's listed 5 to 9, but really the last question is not, it's going to be asked if there is one of our solutions that you would use, but we are not using it for the underwriting decision. So here's your knockout questions. Do they currently use any mechanical devices? Wheelchair, walker, oxygen, quad cane, motorized scooter. Pretty straightforward there, right? If they can answer no, we move on to the next one. Are they currently receiving or need help doing any of the following, their ADLs, activities of daily living? If they can answer no, we move on. Do you currently have or been diagnosed with Alzheimer's, dementia, multiple sclerosis, muscular dystrophy, Parkinson's, memory loss? Again, answer no, we move on. Do they currently have AIDS or AIDS-related disorders? Again, we answer no. Now we've got instant approval if done through our e-app process. So pretty straightforward here, a great way to put long-term care planning in place by doing a simple 1035 exchange. Now, we can do a single deposit if they wanted to. They don't have any existing non-qualified annuities and they wanted to just purchase one of these solutions so that all of those benefits and even the gain portion would be income tax free if used for long-term care. We can do that as well. But we see a lot of those going towards a 1035 exchange. All right, so that was annuity care. Now I want to get into really probably 80% of our total portfolio is asset care. And that is our life-based chassis. And again, I'm not going to go deep into the weeds except for one solution that we're seeing a lot of business on. I talked about our recurring premiums early on. Here we can see that we've got, the pay to age 95. That's our annual pay, if you will. And I mentioned this earlier as well. But over 60% of the policies that were coming in today are coming in with some form of recurring premiums. So whether that's the pay to age 95, a 20 pay, a 10 pay, a 5 pay, whether that's a single pay on the base and some other recurring premium on the rider, that will all factor into those. So lots of ways that we can do these types of plans. Here's the best part about that recurring premium basis and why I think we're seeing, well, I'll give you a couple reasons why I think we're seeing more recurring premiums being done out there. I think with all the volatility in the market, the questions that are going on in the government, I mean, what a horrible situation that happened over the weekend. all politics aside, just that, I mean, nobody should be shooting at anybody. I'm sorry. That being said, all that volatility, all the things that are going on in the marketplace today, people don't want to put a large sum of money in any one place. So I think they're going to these recurring premiums due to that fact. But the other main reason is that with any of our recurring premium options, so all those listed here, when one person goes on claim, we're going to waive the premiums. So waiver is built in on these solutions. Now, I will make this very quick point. In California, it's a little bit different. You actually have to add the waiver, but we are finally getting close to being approved with our latest version of product in California. So I think that will have the waiver soon as well. But I just wanted to point out, if you've got a case tomorrow, it may, you know, and you're in California, you may have to add the waiver of premium. So, but again, all other states, we're not available in New York, but all other states we are, have the waiver of premium built in. So any recurring premium has waiver of premium built in, and whether it's one person out of a couple, or if it's just one on the policy itself, once they go on claim, those premiums are waived as long as they are on claim. So great little piece that I wanted to talk about there with you as well. All right, now one area that we're seeing a ton of business is using qualified funds. And if we think about this for just a minute, I can see why we are receiving so much business here. Well, first and foremost, we put a very simple solution in play. It's a kind of a one and done, set it and forget it using qualified funds. And I'll explain how it works here in just a minute. But I think that that's one portion of it. But if you think about America as a whole, where are we saving money today? It is all in qualified scenarios, right? Whether it's a personal IRA, 401ks, 403bs, what, you know, could be, you know, any of those qualified scenarios that are out there, any of those can be used to plan for your long-term care with us here at OneAmerica. Now, because we're so top heavy as a country in using qualified funds, it just makes sense. Why not we just take a small portion of those qualified funds and use that to protect the rest of the portfolio? So here's how this qualified solution works. It's very simple, but I wanted to give you a little bit of a hypothetical here, if you will. But it's a joint policy for both a male, female, both age 60. Now, what we're going to do is take whatever qualified source they have and do a direct trustee to trustee transfer. So it's a direct rollover, no taxation there. And right off the bat, we give it a 25% bonus. So let me explain this. So let's say that, you know, the female here was working at an employer and then, you know, maybe retired early or whatever the case may be. Well, that old 401k was just sitting out there. It was worth $200,000. And they decided, hey, we've not planned for long-term care yet. Let's use that for our long-term care planning options. So we do a direct trustee to trustee transfer on that $200,000. And right off the bat, we give it a 25% bonus. Who doesn't like a bonus? And a healthy one at that. So now instead of $200,000, we've got a $250,000 sitting in a qualified annuity at OneAmerica from that direct transfer and that bonus. And we're going to use that to fund a 10-pay life and rider solution. So we're going to break that $250,000 up into 10 equal parts, right? And that will fund this 10-pay life-based policy here and unlimited rider solution. So you can see we leveraged that $200,000 that they gave us in forms of a death benefit up to $236, excuse me, of a death benefit. But we're going to fund that with the $250,000 that's in there, and we're going to break that into 10 equal parts. So that distribution over 10 years is $25,000 from that qualified annuity going to a non-qualified 10-pay solution here on the bottom, right? Now, because it's going from a qualified to a non-qualified, those portion or those 10 years, that amount is taxable. Now, In this particular example, it happens to be 25,000. It could be 10,000. It could be whatever that distribution is over those 10 years will be taxable to the client. So each of those 10 years, starting in year one, they will get a 1099-R for that distribution. So that's probably the main thing that you need to remember on this type of solution. But it's a simple one and done transaction. We take care of everything else. Everything else is done behind the scenes, and we will send out that 1099-R. Now, what's also interesting about this is not going to happen in the 60-year-old's lifetime, but let's say we started at say 70, and now those clients turn, RMD ages and have to be forced to take those RMDs. Well, here's what's really unique about this as well. Because of the way we structure this, those payments from the qualified distribution there will be countable towards their RMD calculation. So we're seeing really two types of planning, or ages, if you will, that really kind of 59 and a half up to age 70, and then 70 up to age 80. We're seeing more planners there as well, because they don't need their RMD for income. They're just looking for a way to satisfy it. And so they're utilizing this as well. So wanted to give you some of those great insights there. You can see how that 25,000 is split between both the base policy and the rider. And now you can see the benefits that gives them as well. Over $8,000 per month per person for as long as either one of them needs. I mean, what a great extended care plan. What a way to put your client's mind at ease doing this simple qualified solution. So there are some things to remember, and I thought I would quickly mention those here. Any qualified source. So I talked about that, right? IRAs, 401ks, 403bs. Doesn't really matter what that qualified source is. We can use any of it. It is a direct trustee to trustee transfer, so no taxation there. The only taxation happens on those 10 years of distributions. One good thing is many times we've got spouses that are doing this, right? They're putting a joint plan together. Well, even if every once in a while this happens, one of the spouses is declined. Well, even if it was that declined spouse and we were using their funds, we can still use their funds for that spouse's plan. So even that declined spouse, not that we can get coverage for them, unfortunately, but we can still use that fund, those funds for the insurable spouse. So I thought I'd mention that. It's RMD eligible, just like I mentioned earlier on that distribution. So once they reach the age of majority, if they don't need their RMD for income, it's a great way to help satisfy that RMD payout. Inherited non-spousal IRAs. So we're seeing more and more of this happening, and it's all because of the great wealth transfer. That is basically the older generations passing money on to the younger generations. We call that the great wealth transfer. So we're seeing these inherited non-spousal IRAs getting passed down to, say, children. So because of the Secure Act, though, the changes that happened there a few years back, those must be drained in 10 years. Well, this particular solution works perfect for that, right? We didn't design that with the Secure Act in play. We actually had this designed prior to the Secure Act coming out, but it works perfectly for those inherited non-spousal IRAs. So think of that, just another arrow in your quiver, if you will, for any non-spousal inherited IRAs that you may come across. And how about gifting? The gifting strategy. Can I give you another great way to use this as a gifting strategy using qualified funds? So when I get through this whole slide, you're going to find that the numbers are all the same. It's still the same joint policy for this 60-year-old male and 60-year-old female. However, what's different here is now it's the son of a 80-year-old mother who's the IRA owner, and she's going to gift them this $200,000. So same plan for the son and the daughter-in-law, but the only difference is where the source is coming from. It's from that 80-year-old mother who's the IRA. She would rather see something be put in place for them that is going to help them in their lifetime than waiting for herself to pass. And maybe the son going out and buying a $200,000 sports car and 3 months later wrapping it around a pole or something along those lines. So again, all of the numbers here are exactly the same as what we talked about before. The real difference here is this 80-year-old mom who is doing the funding source. But why is it important maybe that a gifting strategy might be another way to really do this? Well, mom pays taxes in her tax bracket, typically going to be lower, right? I mean, both the son and daughter-in-law in their 60s, that's the height of their earning potential. So they're probably in the highest tax bracket, or certainly higher than the mother probably is. So she'll likely pay lower taxes. Of course, it counts towards her annual gift. So we're covering 2 people here. So that could actually have up to $36,000. We're only passing on $25,000. So it counts towards her annual gift for her children. Son's still the owner of the policy, so he's in full control of it. It creates this great plan of care for both the son and daughter-in-law. Obviously, if they never need it, so the son and daughter-in-law never need it, it creates a legacy in the form of that life insurance death benefit for her grandchildren as the beneficiaries. So again, really creating that legacy as well. And again, no need to wait to inherit that money. She's making sure that that money gets used wisely. So that is the major part of what I wanted to talk about today. The last thing that I did want to mention, though, is you've got a great team there at IMES. Your sales director at IMES is going to help you with any of those client situations that you have. They're your first stop, right? So please bring your client solutions their need for any of these long-term care plans and what sources they have, and let those sales directors help you build a plan for your clients. They're the first line of defense. But I will say this, we also have 17 regional sales directors running around the country, and you can see the different colors on this map. So depending on where you happen to live, they can help do like client seminars. They can even be point of sale support for you to help close these types of businesses. They can do some just trainings for your office. So if you have any interest in any of that, please let IMES know. They'll reach out to me, and let's put you in contact with any of those regional sales directors out there. This is another great resource for you to really help you build more revenue into your practice and help more of your clients be covered from the extended care conversation. So with that, Paul, I'm going to open it up for any questions that happen to be out there.
Awesome. Thanks, Brent. I really appreciate it. I haven't seen any questions come through just yet on this. Okay, I did have one question. It says, what happens if the account funds if neither of the spouses need LTC?
Oh, what a great question, because I did not hit that. I thought I hit everything, but I guess I did not hit that. So great question. On all of our solutions, right? Whether it's the life chassis, whether it's the annuity chassis, if they don't need the benefits, right? So they never have any long-term care claims. Well, that death benefit is going to be passed on tax-free to the heirs, right? The annuity, if there's any gain in that contract, would still be, well, the whole annuity would be passed on to those heirs as well, but there could be some taxation because of the gain in that contract. But again, live, quit, or die is a great slogan that we've had since we've come out with these solutions. And basically, the lives are covered. So if they need long-term care, they've got the ability to pay for those services. If they don't need it and die, it passes on to their beneficiaries. And if they just decide to quit, it's still their asset. They have access to that money as well, and they can walk away. So live, quit, or die, there's always something available for these types of plans. And that's why, again, I'm starting to see a real shift to these asset-based planning over some of the others that are out there. Great question.
Nice. Yeah, one gentleman asked, is this being recorded? And it is, and I can circulate any information out there, anybody, if they have questions on this, or if they're looking at getting contracted with OneAmerica, definitely reach out to me, 1-800-255-5055, and I'll be able to assist with that.
Any other questions out there, Paul?
Let's see. I said, can you discuss in the detail what kind of client profile is suitable for the asset care versus the annuity care, and what's the trade-off?
Trade-off probably between the two.
Yep, trade-off on the two types of policy designs. Yep, there we go.
Yeah, another great question, because I did not hit that. So thank you for these are almost like served up for me on a platter. So thank you for that question. So when to use where? So I look at it this way. Clients, with those that have probably 250,000 in assets is certainly one that we want to start looking to plan for any long-term care planning, if you will. So 250,000 and above. Even those really ultra high net worth individuals, I think it's wise to do a plan there, even though they could probably purchase a nursing home themselves. With all of the care coordination services and our claims concierge programs, those are great things that come with these types of plans. So the wealthy know also to leverage their money, and they're going to get that out of here as well. So 50 and above, again, 250,000 in assets all the way up. Where to really look for these types of solutions. So again, maybe starting at age 50, I would say for our life chassis, all the way up to age 70. So 50 to 70 is a great age range to look at that. 70 and above. So let me give you the actual ages for what we can do with our solutions. First and foremost, the life chassis is available from 35 up to age 80. Our annuity care solutions are essentially from 40 up to age 85. So we get an extra 5 years there. But at age 70 is kind of the area that we start to move from asset care, our life-based chassis, to annuity care, our annuity-based chassis. And the reason for that is we find more leverage at those ages. So once they reach the magical age of 70, we really are shifting more towards the annuity type of planning. So hopefully that will help. And like I said, we can actually go on a base only annuity all the way up to age 87. Now we couldn't add the COB rider to that, but age 86 and 87 on an exception basis, we can do a base only solution, kind of like what I talked about early on in this presentation. So we've got the widest breadth of ages to really plan for here at OneAmerica as well. Great question.
All right. I guess last question here before we get things wrapped up. Someone asked about the Ensight.
Great question as well. I did not touch on that. So Ensight is a quoting. Well, it's really it brings our quotes to life. Look, quotes are very black and white, right? Ours has a little blue in them, so maybe there's 3 colors. But it really brings this 3-color quote to life in a sales presentation that is customizable. It is easy to work with your clients, and you can just follow. So if you've never sold any long-term care before, use our Ensight presentations, the sales presentation that is there. It's very dynamic, and it's a very simple, easy to use presentation that you can flow through and really explain all the benefits of the policy to your clientele. It is only available today on our life chassis, so asset care. It's not available yet on annuity care. We're working with Ensight to put those stories together as well. But that is a great solution to be using out there as well. You know, many of you probably don't focus on long-term care, and what a great way to have this really easy sales track to follow through with your clients and present the benefits to them. Another great question.
Awesome. Well, thanks again, Brent. I really appreciate you taking some time, and thanks to everybody attending with us and going through this product. If y'all have any additional questions, like I said, reach out to me. I'll be glad to get you some more marketing material over. Brent, anything else you want to add?
Well, I want to say thank you to everybody as well. I don't know if you still have the follow-up questions that you're doing after this one or not, but yeah, thank you to everybody who attended today.
Perfect. Thanks, guys. I really appreciate it once again, and I hope everybody enjoys the rest of their day.